Could you save a ton of money by deducting student loans on your income taxes? The answer is sort of. The very best deduction you can hope for might save you a few $100s. Now that's a few $100s that millions of people miss out on because they're just not aware that you can save money as a student loan borrower on your income taxes. So we've got you covered. Check out this video and we're going to show you the 7 key tips that I've got for how to figure out if you could save money on your student loans on your income taxes. And then also we're going to show you a calculator where you can see how much you might be able to save individually. So first, let's talk about who qualifies for this. The way to get the student loan interest deduction is you have to have at least $600 of interest that you paid on your student loans, and you have to have an income that's below a specific level that the IRS says. So for a single person, you have to earn less than $70,000 of taxable income, and if you're a married couple, you have to earn less than $140,000 of taxable income. Now that's something that phases out over time. So for example, you qualify for a lower and lower deduction as you earn up to $85,000 as a single person or up to $170,000 as a married couple. And this deduction, if you do qualify for it, you only qualify for it too if you actually paid student loan interest on a loan that is dispersed in your name, the name of a spouse, or the name of a dependent. So if you don't get told that you paid the student loan interest enough of a payment that actually counts towards the student loan interest deduction, then you might be out of luck. But that's how you qualify for it, is you have to have student loans for qualified purposes in your name or the name of somebody in your family that's not your parent. It has to be somebody that's in your immediate family. And did you have the right income to be able to claim this student loan interest deduction? Second, let's talk about how the deduction works. So you can deduct up to $2,500 off of your taxable income. Now, that $2,500, that's the maximum. If you paid less in student loan interest, let's say you paid $1,000 in student loan interest, that would be the maximum deduction that you could take. So in other words, you can't claim the maximum if you have $50,000 of student loans and you only had interest, let's say from January to March 13th of 2020, then that was a limited period of time that you had interest for that period, and so you might not even have enough interest to even take the student loan interest deduction at all. People are going to have the same problem for 2021 year's taxes because we had no student loan interest on federal student loans all the way up until at least September of 2021. So you might have claimed the student loan interest deduction in prior tax years, and for 2020 and 2021 tax years, you might have a difficulty in claiming it. So that's something to think about as well. Third, let's talk about the difference between a deduction and a credit. So a student loan deduction is the way they're all structured. So all these tax breaks for student loan borrowers are listed really as deductions instead of tax credits. Unfortunately, tax credits are more valuable because a tax credit is going to offset your liability like a dollar for dollar. So if you have $100 of taxes that you owe and you get a credit for $100, then your tax liability is totally negated. Whereas if you have a $100 deduction, that's only going to save you whatever your income tax rate is on that $100 because it reduced your taxable income by that amount. So a deduction is just taking off some of your income that the federal government gets to tax. It's not the same thing as saying, okay, you get a $1,000 tax credit, so we're going to offset $1,000 of your tax liability. So since the student loan tax breaks are structured as deductions, they're not quite as valuable as if they were tax credits, unfortunately. Fourth, how much is this tax credit worth? Since you can only claim it if your income is below a certain amount, around $70,000 as a single person or $140,000 as a couple, with phase-outs for incomes that are barely above that. That means that the tax bracket that you will fall in is going to be kind of limited if you're taking a student loan interest deduction. And that tax break is going to be worth a few $100s at most. In fact, the very most that you could really benefit from the student loan interest deduction is around $550 in tax savings. Because again, you're saving a percentage of that $2,500. You're not saving $2,500 on your income taxes. You're only saving a portion of that because it's a deduction, not a credit. So a tax break for student loans, unfortunately, is not super lucrative for you as a borrower. It will save you a few $100s up to that amount, but it's not something that's going to be a slam dunk that's going to save you a ton of money. The good news is that you can claim it without having to itemize your deductions. So even people that are doing the 1040 can still claim the student loan interest deduction because it's an above the line deduction. So that means that you get to deduct it even if you have the standard deduction that you claimed. So that's good news. At least it's a pretty easy deduction to claim if your income is in the right amount and you've also had some student loan interest that you paid on your student loans that year. Number 5, how do you claim student loan tax breaks? If you qualify for the student loan interest deduction, you're going to get something called the 1098E from your student loan company. That's only going to happen if you paid at least $600 in student loan interest for the calendar year. And remember that 2020 and 2021 are really weird years because of the suspension of student loan interest for federal student loans. Private student loan borrowers, it'll be a little bit more straightforward, but a lot of times when you're a private student loan borrower, it's because you have a high income and that's why you refinance in the first place. So you might not qualify for that reason because the student loan interest deduction is limited as to who can take it. Sixth, what to do if you don't qualify. There are other student loan tax breaks out there. One is from the Secure Act in 2019. It allows you to claim up to $10,000 lifetime withdrawal from 529 plans to pay student loans without having to pay any taxes on the withdrawal. Now, unfortunately, 529 plans, you make contributions with already taxed dollars. So the only way you would really get a tax break out of that is if you got a tax break on the state income taxes when you contributed. A lot of states will give you an income tax break on contributions to 529 plans up to a specific amount. And also, presumably, if you put money into a 529 plan and that money had gone up in value, maybe you could pull that money out without having to pay taxes on the earnings, which is a little bit of an advantage. But most people, you could only really do that to save a few $100s on your income taxes. So again, even if you didn't qualify for the student loan interest deduction, there are some other deductions out there, but it's kind of hard to qualify for them. I'll mention another one in a second that you might like. The seventh tip that I've got is double check your income taxes just to see if you qualify, because so many people, probably millions of borrowers, don't get the student loan interest deduction simply because they didn't realize that they could just put in their interest and qualify for it. It's a very straightforward deduction compared to a lot of the ones that exist out there. So double check your taxes, ask your tax person, hey, do I qualify for the student loan interest deduction? It's worth asking them because it's worth a few $100s, which if you're using a tax person would probably even pay for their help. Before I get to one more tip for you, I want you to watch this student loan interest deduction example of how you can use our calculator that we're going to link to in the description of how to calculate exactly what kind of deduction you could qualify for. If you want to see exactly how much of a student loan interest deduction you might qualify for, check out this calculator that we made on studentloanplanner.com. We're going to include a link to it in the description below this video so you can put in your own numbers and see what you might qualify for. To find it in the menu, you can simply go to Calculators under the Resources tab, and then you can see the Student Loan Interest Deduction Calculator. Notice that there's also several other kinds of calculators here on the menu as well if you're a student loan borrower. So put in your taxable income from the prior tax year, and then put in your tax filing status and just answer a couple of questions. For example, were the student loans dispersed in your name that you made payments on? You can put in how much interest you had on your student loan debt, as well as what state you live in, and that will show you your estimated savings in the federal level, the state level, and don't forget that also student loan interest deduction would lower your taxable income, which would save you money on your student loan income-based repayment amount as well, because it lowers your taxable income, meaning that they're going to take a lower percentage on that payment for the income-based repayment program for the next year. Then you can also see the total savings on federal and state income taxes on a projected basis, as well as the total savings if you include an income-based repayment plan if you're pursuing that kind of a plan. You can also change what state you live in to see what the savings are at a state level, and you can also put in a different tax filing status, such as being married, to see how much of a deduction you would qualify for. For example, if you're making twice as much money, and let's say you paid $5,000 of student loan interest, in that case you would qualify for the maximum deduction, and then you would have the savings listed below on a projected basis. You can also see what would happen if you change your tax filing status to married filing separately, which would make you ineligible for the student loan interest deduction, as well as what would happen if you simply earn too much money to qualify for any deduction at all. Keep in mind, you're able to put money into retirement savings to reduce your taxable income in some cases. So for example, this couple making $180,000 could save $19,500 in a 401k plan each if they qualified. And that could reduce this person's taxable income down to $141,000 as a couple. And so then they would go from not qualifying for a student loan tax deduction at all to qualifying for a decent one that would save you several $100s. So take a look at this calculator and put your own numbers in to see how much you could save. So the last tip I've got for you is check out our video on the employer student loan repayment contribution deduction. This is a deduction that's actually a lot more valuable than existing student loan deductions for taxes, because this is one that's run through the employer. Your employer has to set up the plan, but you might be able to get thousands of dollars in tax savings instead of hundreds of dollars in tax savings on the existing student loan deductions that are out there. Thanks so much for watching. I'm Travis from Student Loan Planner.